And what we think, Julian, looking at the structure of the business cycle, this and our expectations of a weaker dollar and lower rates and potentially lower oil prices, this should actually extend further. So we should see a full ISM cycle above 60, probably into Q1, which is one of our ideas, not yet confirmed, about an extended cycle. So we should see the business cycle be strong all year.
Hey guys, welcome to Everyday Finance. Raoul Pal and Julien Bittel present a comprehensive analysis of the current state of Bitcoin and the cryptocurrency market as a whole, based on careful consideration and analysis of data. Through the examination of historical market cycles, such as previous bull and bear runs, they attempt to identify patterns and clues that may provide insight into what lies ahead. Understanding macroeconomic signals, investor psychology, and the ways in which institutional and retail participation shape momentum are all areas that receive a significant amount of attention. A balanced perspective is provided by them, which acknowledges both the potential for positive outcomes as well as the potential for negative outcomes. In their discussion, they highlight the importance of timing, positioning, and risk management as essential tools for navigating volatility. They also discuss how current trends align, or do not align, with previous cycles. Their central message is that in this rapidly changing environment, it is essential to have a strategic framework and to be flexible, regardless of whether you are fully committed or watching from the sidelines. Take a listen.
As you know, Julian and I have built a massive framework. We're not just shooting from the hip, using a few charts. This is based on 30 years of work and understanding of where we are. So as ever, I like to start with the big picture so you understand how we think of things. Now, this is the core work that I've done for a long time at Global Macro Investor, and Julian and I put together in something called the Everything Code, is where it all came together. And I'm not going to go through all of the Everything Code. You can see the YouTube video about it, but this should update you and understand. So this work is Global Macro Investor. As I said, this is where our big thinking gets done, where all of the new ideas come from. That's the premium research service that most of you don't get and can't afford and whatever. But I do like to give it out to people from time to time to make sure you understand how we think. Before we kick off, I just want you to stare at this for a little bit. This is the Don't Fuck This Up rule book. And it's how to navigate these times. No leverage, right? Anybody with leverage has been blown up. No FOMO. So don't chase the peaks and don't sell at the lows. The further you are out the risk curve, the further your bag is down now. That's okay. I have SUI Solana as my main holding, so they're down more. Bitcoin is down less. You need to understand the risk curve. Then don't get fleeced. Don't lose control of your tokens by attaching some stupid website. Only have a small DJing bag. Remember when everybody thought that memes were going to be the biggest thing of all time? They've all gone to zero. That's because that's so far out the risk curve. It should be small and it should be there for fun, yet unlikely to make a fortune. The longer term time horizon is everything. Zoom out, remove the noise, and most importantly, expect 35% pullbacks frequently in Bitcoin. And that means more in alts. And buy the fucking dip if you can. So those are the rules, so don't fuck this up. Understand that as we go through the presentation, and you'll understand the opportunity set. So let's go through the Everything Code. The Everything Code is the overall thesis of my understanding of how we got to where we are today, where we're going, and how it all comes together. Yeah, the Fed cut is such a red herring because that's delayed versus actual liquidity, actual financial conditions. The financial conditions are the key thing, and you'll go through that because financial conditions have been easing so fast that it sets you up for something incredibly bullish, which is, I know it's hard because people today trade the fucking headlines. And what they should be trading is what happened 3 months ago. And they don't understand this lead and lag between what drives markets and markets themselves. So everyone creates false narratives around stuff. Anyway, we'll talk about that as you go through your bit. So let's go through your bit.
Yeah, nothing changes sentiment like price, right?
Yeah. Or narrative like price. Everyone's narrative fits.
Well, the first thing I'm just going to say before we get into the charts is, Raoul and I had spoke last week, and we were like, Raoul wanted to do a flash update just, to help people. And of course, I thought that was a good idea. We ended up putting a pack together. But then I also had a lot of important charts that I wanted to share, for MIT. And I was going to write this all up in the weekly letter for this week. But then Raoul was like, well, why don't we just do collectively, a flash update for everyone, make this available as a one-off. Of course, if you're, as Raoul had said, if you're plus or pro, after this, we're going to do, some questions. So that's kind of the value add there. But really, we just
that's on just for everybody. Just sign up now while we're just going through this stuff. So realvision.com/join. It's free. And then you get all the questions and the nuance afterwards. It will help you a lot because we've got questions piling in from Plus and Pro members. But everyone gets to listen to us answer the questions.
What we had been writing about in Q4 when we started to address the outlook was the fact that financial conditions were tightening very quickly. And on X, I even wrote quite a long thread about the dollar wrecking ball. And that's really what we're feeling now within the data and markets, which we'll go through in this presentation. But when you look at this, so this is the dollar and bond yields, right? Inverted, so the teal line, and advanced by 2 months versus the US Economic Surprise Index relative to G10. So we've seen US data coming in below consensus expectations and below that relative to what we've seen globally, meaning that the US has weakened disproportionately faster.
Because the dollar has been too strong and rates have been too high, or they were in the past.
Correct. And so we saw it, that was the back half of, by the way, the back half of 2024 was a very positive environment for risk taking. And here we are again, now that the dollar and rates are coming down so fast, setting the stage for an environment where we believe growth momentum will start to bottom and turn higher. And we'll talk all about this.
Peter Schiff and Michael Saylor, both of whom are well known and have strong opinions, find themselves once again engaged in a conflict that is reminiscent of the past regarding the legitimacy of Bitcoin. Which spark is it this time? Saylor sent out a tweet that appeared to be quite straightforward. 1 Bitcoin equals 1 Bitcoin. Schiff jumped in with his trademark skepticism, quipping that Bitcoin's only worth is itself. On the surface, it appears to be a reference to the self-referential value that Bitcoin possesses in a world where fiat currency is constantly being devalued. The essence of their long-standing disagreement is encapsulated in this exchange. Bitcoin is a speculative asset that masquerades as a store of value, according to Schiff, who is a staunch supporter of gold. He believes that Bitcoin is too volatile, too unproven, and too similar to a technology stock. Saylor, on the other hand, advocates for Bitcoin as an exceptional and unchangeable form of currency, referring to it as digital gold for the 21st century. It is interesting to note that despite the fact that they spar frequently, they have never engaged in a full-fledged, face-to-face debate. It is only because of this absence that the ongoing tension and drama are fueled, which keeps followers of both camps engaged in what has become one of the most iconic ideological standoffs in the cryptocurrency industry. Watch more.
We've been flagging this economic weakness in Q1 all the way back in October, November of last year.
Correct.
Saying that Q1 is going to be weak and it's going to set the Fed up potentially to cut rates. All sorts of things are going to happen. The economic data has been weakening, and this is playing out as we've talked about.
That's right. And so the GMI Financial Conditions Index is a regression on commodity prices or certain commodity prices, certain bond yields and the dollar. Okay. And what you can see here, once again, is that this is what's been driving growth weaker in Q1, but now on the basis that, inflation or tariffs are, well, they were inflationary, but now the market's obviously reversing that narrative. Dollars lower, which was, again, one of our base cases heading into this year, something we'll talk about also a little bit later. Rates lower and commodity prices lower is now goosing our financial conditions index. So it's moving a lot higher, which again is setting this setting the framework or the groundwork for economic data to start coming in above consensus expectations. Now, I said back in mid-March that the economic surprises would bottom in mid-March, and that's currently seems to be the case, and this will become more evident as we.
But they won't start accelerating until May. So we'll have softish data and a nice backdrop for the Fed to cut.
Yeah, it's not the point. It's not going to happen so fast that all of a sudden the Fed's going to back off. That's for sure.
No,
but they're still going to rise.
Fed cutting is good for Main Street, not Wall Street, particularly. It doesn't really make a difference because Wall Street trades off financial conditions.
Correct. And then when we look to the extent at which, and this is the chart I had shared on social yesterday, right? To the extent that Bitcoin prices have not only already priced in a lot of the weakness in the City Economic Surprise Index, it's fully discounted the Q4 tightening in financial conditions that we had been talking about.
Now, remember, Julian, we were using this chart that got us the exact low in the October, November, December period in 2022. It was the financial conditions that we've used as our key indicator for the key reversals in narrative and price.
Yeah, that's right. And I think I don't remember if it was September or November, but we wrote the GMI article, "The Turn is Near," and charts like this one featured in there. So this was a big basis for that. So we know that this works, is the point. The other thing is that I can see a lot of people talking about the widening in junk spreads, so credit spreads, and that being the result of Trump's tariff announcements last week. I mean, that's true and not true. It actually is the result of the market speculating that tariffs were inflationary, which all happened in Q4, which tightened financial conditions, which started to drive credit spreads higher. So credit spreads have actually been widening, much like the City Economic Surprise Index has been slowing over the entire since the beginning of the year. Now, last week, credit spreads obviously jumped a little bit more, I think by 20, 30 basis points on the fact that the VIX is spiking and equities are selling off. But the reality is that credit spreads are widening because of everything that happened in Q4 of last year. The market reaction to last week's statement is more of an overreaction, but really what's gone on, which I'll show to you later, but really this is all a symptom of tighter financial conditions in Q4, which is now reversing. Now, I said I would show you the updated version of this chart. So at 49.7 back in Feb, people were saying, well, it's a recession. We were saying, well, financial conditions are now easing so quickly, this data would improve over the next 1 to 2 months. And we just got this data last week, and we saw the services PMI jump to 54.4. Okay, so improving and not a recession in our view. And then the next thing, I'm just going to say is that, I don't expect the white line to go higher in a straight line. But if we look at the OECD data, so this is their leading indicators. We look at the percentage of countries rising month on month. So this would be a measure of global economic breadth. The fact that financial conditions are like our daily real-time proxy for this kind of metric, and that it's moving higher so quickly now that the dollar and rates are dropping and commodity prices, this will goose lead indicators in the future, right? So we're in an environment where growth momentum should now begin to improve after we spent the last 3 months decelerating, okay? So next thing I want to talk about is the business cycle. Now, just because this is also being released on YouTube, I'm going to talk about the ISM. And so the ISM stands for Institute of Supply Management. It's basically a monthly survey that goes out to supply chain executives and asks them about new orders, so what they're expecting on growth. It asks them questions about employment, price pressure composites. So are prices rising or are they falling? And it basically creates a diffusion index, which looks like this. So the white line. So anything above 50 means that we're gaining momentum, and anything below 50 means that it's slowing. And what we saw in the latest report in March was that it worked a little bit lower, and that new orders fell rather considerably. But once again, this is a mix of liquidity and some other, credit-based leads. But you can see that really, once again, this was just the result of tighter financial conditions in Q4, which drove new orders lower. So by the time we get to, let's say, April, May data, we should see new orders start to improve, right? And start to rise again, as opposed to going to, sub 40, sub 30, or not maybe sub 30, but, heading into recession. And what's also important is not only are lead indicators starting to improve on the basis that financial conditions have eased over the last 3 months, but you can see here, if we're talking about Bitcoin pricing, we've already priced in a slowdown to around 47, 47. Okay, so it's already in the price. And then when we look at this famous chart, if we look at new orders less inventories, this is largely a one-off. If we talk about the spike in inventories, obviously front-running tariffs, right? But this is also, if we look at cyclicals versus defensives, it's already fully in the price, right? And then when we scratch the hood and you look at the number of industries reporting growth from 1 month to the next, last month we were at 10, today we're at 9. So it was hardly as bad a report as people had speculated. And from here's the really important bit, is that if you look at financial conditions, and this is precisely what Raoul was talking about just a second ago in Q4 of 2022, when we had written our article, The Turn is Near, we were looking at an environment where financial conditions started to ease very rapidly. And here it's advanced by 9 months and currently suggests that we'll end the year, just above the mid 50s. Currently it's suggesting 57.
And from what we think, Julien, looking at the structure of the business cycle, this and our expectations of a weaker dollar and lower rates and potentially lower oil prices, this should actually extend further. So we should see a full ISM cycle above 60, probably into Q1, which is one of our ideas, not yet confirmed, about an extended cycle. So we should see the business cycle be strong all year.
As geopolitical and economic tensions between the United States and China resurface with force, it is possible that Bitcoin is getting closer to a moment of critical importance. As a result of the recent action taken by Trump to impose a substantial tariff of 50% on Chinese goods, a financial tug-of-war has been reignited, prompting Beijing to swiftly retaliate. Because of this increasing friction, global markets are experiencing a surge of uncertainty, and Bitcoin is beginning to reap the benefits of this. The analysts at Matrixport are drawing parallels to the devaluation of the yuan in 2015, which was a time when the value of Bitcoin initially decreased, but then skyrocketed as investors sought refuge from the instability of the currency. Today, with the US dollar to Chinese yuan exchange rate hovering near key resistance and growing fears of inflation and market disruption, Bitcoin is once again being viewed as a potential safe haven. This is especially true for investors who are looking to escape the ripple effects of the traditional financial system. In the current high-stakes economic standoff, Bitcoin is not merely a spectator, rather it has the potential to emerge as a significant beneficiary. The narrative of Bitcoin as digital gold is gaining renewed relevance, and if the tension continues to escalate, it may trigger a breakout that positions Bitcoin as a go-to hedge in a world that is becoming increasingly unstable. Thanks for watching.